Good morning, good afternoon, good night. Welcome back to another Schema Scalper video, or welcome to a Schema Scalper video if you're new. In today's video, we're going to be continuing our CME group education, introduction to FX, understanding the FX delivery and settlement process. That was the last video in the playlist of the series, and now on to the next one: how to manage risk in FX. This is the next video, the next lesson 5 out of 6. We are 2/3 the way done with this course, the lessons of this course inverted commas. How to manage risk in FX.
Given the interconnectedness of today's global economy, it is hard to imagine a medium to large-sized company that is not exposed to currency risk. Such risk can result from importing parts or components, or from exporting finished products to foreign markets. It isn't just manufacturers either. Asset managers with large positions in foreign securities not only have exposure to underlying asset value variability, but also face exposure to currency in which that asset is priced. In light of these considerations, risk managers are well aware of currency fluctuation risk to their business. One way to manage currency risk is with a currency overlay program. The objective of a currency overlay program is to limit losses and maximize gains that arise from the currency rate fluctuations. Strategies can be passive, active, or a combination of both. Let's look at an example. Say a Brazilian asset manager decided to allocate 40 million reais into U.S. equities. By investing in U.S. equities, he has two risk exposures: a U.S. equity price risk exposure and a U.S. dollar versus Brazilian real currency exposure. For this example, we focus exclusively on the currency risk exposure. In order to invest in U.S. equities, the Brazilian asset manager must first convert his cash from Brazilian reais to U.S. dollars, starting with a 40 million reais position and an exchange rate of 4.0 Brazilian reais to U.S. dollars. The 40 million reais exchanged to dollars equates to 10 million U.S. dollars. He then can make his investment in U.S. equities. What is his currency risk? By converting from Brazilian real to U.S. dollar, he is now exposed to a weaker U.S. dollar. If the dollar goes down in value versus the Brazilian real, when he converts back to his domestic currency, he will receive fewer reais, reducing the return on his investment. How might he hedge this currency exposure using FX futures? Brazilian real futures are quoted and traded in American terms. When the term's currency weakens, in this case the US dollar, then the futures price increases. Therefore, to hedge a weaker dollar exposure, our manager would be a buyer of the BRL USD futures. How many contracts would he buy? His risk in Brazilian terms is 40 million reais, and the futures contract notional value is 100,000 reais. Divide the at-risk amount by the contract notional amount to arrive at a hedge ratio of 400 BRL USD contracts. BRL USD futures trade at the inverse price to the spot convention. The exchange rate was 4.0, which would be 1 over 4.0 or 0.250. This means our asset manager would buy 400 BRL USD futures at a price point of 25000. Consider what happens if the US dollar weakens relative to the Brazilian real. Assume the exchange rate moves from 4.0 to 3.5. With no change in the original investment, the US dollars would now convert to 35 million reais, which is a 5 million reais loss. What happens with the hedge? With the spot rate dropping to 3.5, the futures would now be priced at 0.28570, which is the price nearest the inverse of the exchange rate, or 1 over 3.5. The purchase price of the contract was 0.2500, so the difference in price is 3,570 points higher. If we multiply this increase by the 400 contracts, we get a 1,428,000 profit from the hedge in US dollar terms. Converting this amount back into Brazilian reais at the 3.5 exchange rate results in a gain of 4,998,000 Brazilian reais from the hedge. If you subtract the gains from the hedge position from the loss resulting from the currency rate change results, we end up with a 2,000 reais loss for the asset manager. This small loss is certainly more acceptable than a 5 million reais loss if left unhedged. As demonstrated, this is one way market participants could hedge their currency risk. CME Group FX Futures and Options on Futures offer risk managers a variety of products and tools to help them manage their FX risk.
Okay, super interesting. Went into hedging and how to use hedging to manage risk when trading FX. Or not trading FX, when converting FX and trading other asset classes. Super interesting. Okay. Given the interconnectedness of today's global economy, it is hard to imagine a medium to large size company that is not exposed to currency risk. Such risk can result from importing parts or components or from exporting finished products to foreign markets. FX risk is not just for manufacturers, asset managers with large sorry. FX risk is not just for manufacturers. Asset managers with large positions in foreign securities not only have exposure to the underlying asset value variability, but also face exposure to the currency in which that asset is priced. Okay, cool. Face exposure to which the asset is priced. So if I'm going to buy a car in Europe, paying euros, the car is then the asset. If we're saying it like this, the asset, and I have rand or I have dollars. So it'll be USD, the Euro USD conversion, and then a hedge of that until the asset gets to me, and then I make a profit or loss on that asset, but the hedge position would then do inverse to that. So it would be a smaller loss or smaller profit. I'm not sure. Looking into that. In light of this consideration, risk managers are well aware of currency fluctuation risk to the business. One way to manage risk is with currency overlay program. So that's what they just showed. The objection of a currency overlay program is to limit losses and maximize gains that arise from currency rate fluctuations. Strategies can be passive, active, or a combination of both. Okay. FX hedge example. Consider a Brazilian asset manager who decides to allocate 40 million real into US equities. By investing in US equities, it has two risk exposure: the US equity risk exposure and the US dollar versus Brazilian real exposure. Okay, this makes sense now. So if he's buying 40 million real worth of equities or worth of Nasdaq, he has exposure to Nasdaq and he has exposure from the Brazilian currency to the US dollar. For the example, we focus exclusively on the currency risk exposure. In order to invest in US equities, the Brazilian asset manager must first convert his cash from Brazilian reais to US dollars. I don't know why it's called reais. Starting position 40 million Brazilian reals. The Brazilian reais to US dollar conversion exchange rate is 4. So that means 4 Brazilian reals for $1. Yeah. So you divide by 4, use $10 million in. So the asset manager can now invest $10 million in US equities. What is his currency risk? By converting from real to dollar, he is now exposed to a weaker US dollar. If the dollar goes down in value versus the Brazilian real, when he converts back to his domestic currency, which is Brazilian real, because from Brazil, he will receive fewer reais, or real, reducing the return of his investment. Okay, that makes sense. Brazilian real futures are quoted and traded in American terms, which means the US is the term and the other currency is, gosh, quoted, the base in the term. I don't know why I'm getting. When the currency weakens, term currency weakens, so the US dollar weakens, then the future price will increase. Therefore, to hedge a weaker dollar exposure, our manager would be a buyer of real futures 6L, contract symbol 6L. How many contracts would you buy? Okay, this is the part that I do not understand. So here's 40 million real. What I don't understand is why it doesn't break it up into two and then. Oh, never mind, I understand now. So that's his account balance. This is the one trade he's gonna take as a hedge. And then the other trade would be in, or the one position you take is a hedge, and the other position you take was this 10 million investment. Understand that. Understand this part. Understand that. What are currency overlay programs designed to address in an investment portfolio? Currency fraud. High margin costs? Nope, not currency fraud. Hedge for equity loss or existing currency risk? Existing currency risk. No, it's hedged for equity loss. What? What are currency overlay programs designed to address in an investment portfolio? Existing currency risk. Oh, gosh me. I need to read properly. What are currency overlay programs designed to address in an investment portfolio? So the existing currency risk. So it's not meant to hedge for equity losses, which is, we got up here. So there's two risks exposure. So you have the risk exposure for the equity price and the risk exposure for currency loss. So this is what it is. And this is a currency overlay program. Super interesting. Cool. And this is how to manage risk in FX. Dope. Ting 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 ting. And that's the lesson for today. Well, for now. Oh, there will be a playlist upper right or upper left or somewhere on the screen with this whole series, Introduction to FX. In the next video, we'll be looking at a look at FX EFPs. I don't know what that is. And yeah, cheers.